And as we looked at last time, with gold outperforming every other asset class, bar none, a rising gold price has not gone unnoticed by fund managers who have never looked at gold invest for, and this massive move into gold has only just begun. This is the point. February alone evidenced an all-time record high of 4.9 billion flow into gold funds alone. And that so far, and that's, we're talking about US funds. And so far, it looks like March is going to exceed that significant. Now, this gold has to come from somewhere. And with demand competing with Asian investment demand, and that it is bolstered by rising prices, so higher prices gets people more interested in buying more gold, just as it did when gold took off from 2000, when the Shanghai Futures Exchange launched back in March 2024, driving an $800 rally, which really railed against every top call time. Now, with an increasing percentage of futures market bets moving into the hands of funds seeking long-term exposure to gold as an alternative first-year asset, it's forcing bears to fold bets against gold and driving the 50-year unbacked paper to real physical gold gap to close. And as we know, many funds are not able to hold physical gold, so they buy shares in COMEX-related ETFs and exchange traded funds. And these bets are seeking exposure to gold. But they're sticky in nature and unable to be rinsed, as you say, into even when they rig synthetically constructed wash and rinse cycles. In fact, quite the opposite. People have figured the game out. The change in behavior is what we're evidencing here and now. And the physical facing market making insiders are aware and taking advantage of this bullish structural change in the composition of historically unbacked futures markets, becoming backed. And the fresh in-house demand is also competing with the Fed, trying to race to buy back underwater leases at market ahead of the July 1st Basel III compliant deadline. And why would it expect more attempts to cap 3,000 gold into large derivative bets being marked to market into options expiry next Wednesday? And first notice comes directly after that. And then the April contract then expires. Now, or these people are going to have to fully fund these positions for delivery on Friday the 28th. Ultimately, there's far too much offsetting a fresh safe haven buying evident at current prices for the cartel to sustain any lasting downside traction. Yeah, if you recall when we recorded our March 5th episode 2 weeks ago, silver was being capped at, it was $2 lower at $32, where it was pretty obvious that capping at $32 into a strong demand undersupplied global market was going to become way too difficult, as insiders were being forced to short cover so as to accommodate New York dealers actually taking physical delivery to cover their COMEX short exposure. So alongside large backdoor loanouts, this was really forcing the price higher. And now the battle for $34 is there, but once rinsed, liquidity providers are seeing little resistance until the 38s. Now, and that's just short-term stuff. It's not realized that silver will be a major beneficiary of US market Basel III compliance. So liquidity providers see that the cartel's critical upside breakout level is very low hanging, above 34. They may be closer to 35, but it's low hanging and ready to be triggered. And spot silver is readying to breach massive short stops above that level. A pit close above 34 should trigger large short covering process to begin. Now we're looking for clues for the breakout into the massively expanded exchange for physical spreads. They're starting to contract. That's the clue. It's getting very risky shorting silver into a 4-year and growing supply deficits and very strong Chinese and Indian demand. And while these spreads are volatile as the fight plays out, narrowing spreads are telegraphing an imminent upside breakout. And while these spreads have been as high as $1.38 per ounce, capping at this level expanded the EFP spreads to as high as 86 cents just this week to try and block 34 from getting filled. But each risky, asymmetrically imbalanced spread will continue to narrow into very strong Asian buying next week, making it very risky to short silver.
You know, it's not often we get to witness a real-time transition in the global financial architecture. But that's exactly what's happening in the gold and silver markets right now. We are standing at the front lines of a historic shift, a dismantling of a 50-year unbacked paper pricing mechanism, and the quiet birth of a decentralized physical bullion market that's rapidly gaining traction in the East, and increasingly in the West too. And I'll tell you, what we're seeing today is unlike anything we've ever seen before. Let's start with the record-breaking flows into gold funds. In February alone, U.S. gold funds saw nearly $5 billion in inflows, a new all-time high. And it looks like March might even surpass that. This is serious institutional capital moving into gold. And this isn't hot money, this is sticky money. Long-term allocation-based capital, not the kind that panics on a 1% pullback. It's buying for structural reasons, hedging against inflation, geopolitical dislocation, fiat currency decay, and above all, for wealth preservation. These are not traders. These are fiduciaries managing endowments, pensions, sovereign portfolios. They're allocating to gold as a Tier 1 reserve asset. Basel III reclassified physical gold, held unencumbered on balance sheet, as a zero-risk Tier 1 asset in 2019. That right there was the signal. The regulators knew what was coming. Now here's the thing. This gold has to come from somewhere. Physical gold doesn't just appear when investors decide they want it. You're seeing massive competition from Asia, India, China, Turkey, all buying hand over fist. In China, household demand is skyrocketing. In India, despite import duties, silver imports have surged. So when Wall Street flows billions into ETFs like GLD or into COMEX contracts marked for delivery, the vaults get stressed. Real metal is required to back those promises. You see, the price rally in gold isn't just technical. It's being driven by actual delivery demand. And this is where it gets interesting. When we launched our March 5th episode, silver was being held under $32, synthetically capped through shorting by the usual suspects, the cartel, the bullion banks, the insiders. It was so predictable, it was boring. But that pressure couldn't hold. By the third week of March, silver had blown through $34, and now we're watching that $35 level with laser focus. And here's the truth. Behind the curtain, the shorts are starting to panic. Not because silver's moving up, that happens, but because dealers in New York are taking physical delivery to cover their own short exposure. Think about that for a second. The same guys who used to be the paper pushers, playing past the leverage with unallocated contracts, are now pulling metal. That tells you they're nervous, and they should be. We're now seeing a massive shift in futures market structure. Historically, the paper markets, COMEX, LBMA, have been flooded with leveraged speculators, funds placing short-term bets, contracts written against nothing but trust. But now, as institutions seek exposure to gold as a strategic, inflation-resistant asset, more of these futures positions are backed by actual physical gold or by delivery intent. That's changing the composition of the entire market, and that's the danger for the bears. Because here's what's different. These new longs don't sell into price rallies. They're not here for a trade. They don't blink when gold drops $40 intraday. In fact, they buy more. And the usual rinse and repeat strategies, short the futures, slam the options, rig a synthetic waterfall drop, they're failing. These positions are sticky. The risk of a short squeeze, especially with Basel III kicking in hard in July, is enormous. Now let's talk about silver. Silver is the sleeper asset here. Everyone's eyes are on gold hitting $3,000, and rightly so. But silver is coiled like a spring. Since late 2023, we've been tracking widening EFP spreads, that's exchange for physical, between COMEX and London. When those spreads blow out, it means one thing. Supply is drying up and someone's paying a premium to move metal. In early April, EFP spreads on silver hit 86 cents per ounce. An absurd number in a supposedly liquid market. That's your red flag. The cartel was desperate to cap silver under $34. They tried everything. Dumped contracts at the open, spoofed the bids, you name it. But the physical demand is relentless. China and India are still buying every dip. Smart money knows that silver is about to break through a structural resistance that's been artificially held in place for over a decade. So if you're sitting on the sidelines thinking this is some short-term hype, think again. What's unfolding here is the start of a global monetary transition. The shift away from Western paper futures toward Eastern physical price discovery is irreversible. The days of suppressing price with derivatives are numbered, and the time to position yourself before the mainstream catches on is now. Because when the COMEX short positions can't be covered, when delivery demands hit 20-30 million ounces in a single month, when the LBMA admits it can't settle in T+1 and pushes to 8-week delays, you won't want to be looking for product. You'll want to already have it. This isn't just a market trade, it's an escape hatch. And that's where the smart money is running.
Yeah, Shane, it was tariffs, Trump's tariff mandate that really caught the Fed flat-footed. And the sudden race to repatriate paper gold positions into safe haven first-tier gold exposed the inelasticity of the available physical bullion at current prices, meaning there just isn't enough bullion at current prices, meaning that it has to be bought back at higher and higher prices. Now, we previously posted the link and took apart the LBMA video. You remember this video that the LBMA came out and they were saying, oh yes, the idea 8 to 10 week refiner delays for COMEX compliant 100-ounce bars. They're just related to COMEX exchange and, really trying to spin it as, no, there are no real shortages. That backfire, and it drawing really unwanted attention into the real extent of the global supply shortages at current prices. And despite allowable double accounting rules, making the true extent of the supply problems hiding, it's been the failure to physically load out the 400-ounce standard bars from the Bank of England LBMA vaults into a Basel III NSFR T+1 delivery protocol. It's that it hasn't moved that's really exposed the true scale of these delivery defaults. Now, we've previously drawn attention to the largely ignored GC, it's called the GC4 Enhanced Delivery Contract. We spent some time looking at it, which enables a local London 400-ounce bar to remain in the London vaults without physically moving to the US vaults, so yet it's counted as there. Now, these flows also synthetically assist in closing the EFP spread, i.e. the spread between the paper price and the physical price. As an example, we witnessed this into an attempt to block central bank buy stops at spot 3,000 from getting tripped off last Friday the 14th. We knew that Asia would come in and take it, and sure enough, they did. Now, these failures to deliver have not gone unnoticed by competing central banks who have doubled down on targeting and locking in COMEX registered inventory for delivery, alongside locking in exchange for physicals at the AM and PM fixes for Basel III compliant market delivery. So in other words, central banks and sovereigns and the large buyers need a fix. So you might intraday it be higher and lower, but usually it requires an actual fix to mark that to market. So a SARS large size to market. So into all of this maelstrom of bullish inputs, the Fed trying to prioritize 400-ounce bullion repatriations ahead of an upcoming US Treasury gold audit is something that would never have happened had Trump not taken the helm. Now, these repatriation efforts have made it very risky to short sell paper gold into such large physical demand.
And now, as we continue to watch this physical gold and silver shift unfold in real time, we're starting to witness a moment of reckoning for the Western gold price suppression model, particularly with what's happening on COMEX and the LBMA. This isn't just some minor delivery backlog or a temporary spread widening. We're looking at the beginning of what I truly believe is an existential liquidity crisis in the paper markets. Look, when the United States suddenly becomes a net importer of gold, as it has since late last year, and is prioritizing delivery over paper exposure, that's your tell. Almost 25 million ounces of gold have already landed on U.S. shores in a matter of months. This isn't just some reshuffling of ETF balances or gold swaps between central banks. This is real tonnage, physically delivered out of London vaults, headed west. Now ask yourself, why would the most powerful nation in the fiat monetary system, the issuer of the world reserve currency, suddenly be hoarding physical gold while simultaneously unwinding the ability for investors to convert COMEX futures into LBMA-delivered gold? It's a vote of no confidence. Full stop. The decision by COMEX to de-link LBMA futures as a delivery option is seismic. It means that U.S. regulators and exchanges no longer trust that London can deliver on its obligations. That's a serious escalation in what is frankly a monetary Cold War playing out under everyone's noses. COMEX used to allow futures positions to be cash settled in New York or physically fulfilled via LBMA unallocated contracts in London. That bridge has been burned. And why? Because London is out of unencumbered metal. Out of 279 million ounces of gold held in LBMA vaults last month, only 36 million were free for delivery. The rest is encumbered, either owned by ETFs or leased by central banks. And yet, against this dwindling float, there were over 380 million ounces in outstanding paper contracts. That's a ratio of nearly 11 to 1, and it's even worse in silver, where it approaches 12 to 1. How is that sustainable? Now, the mainstream media wants to tell you this is about logistics. We're short on trucks, they say. Not enough manpower. You can't make this stuff up. When the LBMA quietly extends its T+1 delivery terms to T+8 weeks, we're supposed to believe it's because the drivers are sick. Come on, anyone with a basic understanding of how delivery settlements work knows this isn't about transportation. It's about lack of available inventory. And here's where it gets really dangerous. Commercial banks like HSBC, JP Morgan, and Scotiabank, who've used unallocated LBMA gold to hedge their massive short exposures on COMEX for decades, can no longer do so with confidence. Those offsetting positions are breaking down. The rehypothecation system, where the same ounce of gold is claimed by 5 or 10 different parties, is starting to collapse. When you peel back the layers of this system, you realize how deeply vulnerable the entire structure is. This market is built on confidence and opacity, and once confidence goes, opacity becomes risk. That's exactly what we're seeing now. Sovereign wealth funds, state treasuries, and even U.S. banks are starting to shift into fully paid-up physical metal. And they're not just rolling over contracts, they're taking loadouts. That's metal out the back door. This is why JP Morgan delivered nearly $4 billion worth of gold into COMEX in February for a single client. That's not a hedge fund trade. That's a sovereign-level move, and we don't know who it is. Could be the Fed, could be the Treasury, could be a major sovereign like Saudi Arabia or India. What we know is that it wasn't for fun. It was for security, for collateral, for something big. Now, zooming back to silver, while everyone's distracted by gold hitting $3,000, silver is quietly preparing to explode. Right now, silver is hovering near $35, but it's still below its 2011 high of $50. In fact, it's cheaper today, adjusted for inflation, than it was 40 years ago. Let that sink in. An asset that is both monetary and industrial, critical to everything from solar panels to electric vehicles to missiles, is still priced as if it's in oversupply. And yet, according to the Silver Institute, we've had 4 consecutive years of global supply deficits, with another projected for 2025. Where's the metal coming from to meet demand? It's being pulled from inventories that are shrinking fast. The LBMA is down nearly 50% in silver float in just 3 months. And COMEX? Nearly 90 million ounces stood for delivery in March alone. Most of it shipped in from London, which is now drying up. And here's the wild part. All of this is happening while retail is still asleep. ETFs like SLV continue to see outflows. U.S. retail coin demand, while up slightly, is still a shadow of what it was during the 2020 panic. Meanwhile, central banks continue to be net buyers of gold, but not silver. That's the opportunity for the individual investor. You see, silver is not on the radar of central banks, not because they don't value it, but because it's too volatile and too bulky for sovereign portfolios. But for retail investors, especially those looking for massive asymmetric upside, silver is the perfect storm. When the broader public finally wakes up, the move will be violent, because there's just not enough metal. Industrial users won't sell, mints will be backlogged, and ETFs will scramble to find supply to meet redemptions. This is your chance to be early, and let me add this. Basel III compliance is the silent countdown clock. July 1st is when U.S. markets must fully comply with net stable funding ratio rules, which means any unallocated or rehypothecated precious metals exposure must be fully backed or marked for risk. That's going to make holding naked short positions even more dangerous and expensive. Already, we're seeing fewer banks willing to take the other side of these bets. Spreads are blowing out, liquidity is thinning, and regulators are watching. Once COMEX requires higher collateral for unbacked shorts, it's game over for the suppression trade. The price will gap higher. We've already seen it start. This isn't speculation, it's happening. The Shanghai Gold Exchange, meanwhile, is flourishing. It operates on a physical delivery model. If you buy a contract there, you get your metal. Same with Dubai and Moscow. These exchanges are slowly forming the backbone of a new global price discovery system, one based on delivery, transparency, and actual supply and demand. As Andrew Maguire has said for years, the paper game ends when people demand real metal. That's happening now. So what's the takeaway for the average investor watching all of this unfold? It's simple. Do not wait. We are well past the phase of theory and entering execution. The global bullion system is breaking. Western vaults are being drained. Futures markets are stressed. Delivery timelines are stretching. Price suppression tools are failing. And sovereign actors are making their move. The final piece is public participation. When retail floods in, and it will, the revaluation will be exponential. Don't chase. Be early. And I'll leave you with this. When gold was at $1,200, nobody wanted it. When it broke $2,000, everyone said it was overbought. Now it's at $3,000 and the media is silent. The same people who bought NFTs at $500,000 are too scared to buy a silver bar at $35. That's how you know it's still early. You want to be ahead of the herd, not trampled by it. Get your allocations right, stay outside the banking system, hold your wealth in real physical assets, not promises, not paper. Because once this unwind reaches critical mass, you will not have time to react. You'll either already own it or you'll be scrambling to get some. And by then, the price will be set in Shanghai, not Wall Street. This is the end of the road for the LBMA/COMEX cartel model. The physical world is asserting itself. We've spent 50 years in a financial illusion, pretending gold didn't matter, pretending debt was money. That illusion is over. Now comes the reckoning, and it's moving faster than anyone expected.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.